Peter Rose, Longwood Currency Trading. It's cold end of November 2021, and I was working a trade analysis process, and I ran into some interesting things I hadn't thought about that I sort of do automatically, and that's why I've set the title of this video to be "Do Not Set Far Out Forex Trading Limit Orders." Far out doesn't mean far out crazy. It means out away from where you're currently trading at. A far out limit order is really a continuation trade after a previous order has been closed out. So in other words, you're doing a trade entry analysis, and you set up your trade with your profit target and your risk point, and you do your analysis and you set those limit orders, so if the price reaches that, the order triggers, right? When you also do that, and before that order triggers, you also set another series of trades. So for example, I'm going long, and I see at 1.0000 I've got an entry point, and at 1.00020 I'm gonna have a profit target. And so you set that up, and then you add another entry above that 1.0020 profit target. You go up maybe another 5 pips or 10 pips or something. You set a new buy order followed by a new profit target. Those are called far out limit orders because they're far out. They're like an out of the money call option or whatever, if you're familiar with stocks or whatever. But by setting a far out limit order, what you're really doing is an anticipatory trade, right? Which I discussed in a previous video that I did. Don't make anticipatory Forex trades. Okay, so you may want to check that video out because it's so parallel to what I'm talking about here, except I simply put it in the context differently than what I'm saying that this is. This is a far out limit order is an anticipatory trade that's done after you're making a good trade entry analysis and for your current trade. Whereas an anticipatory trade is done, you're looking at this entry position. I'm going to get in right now, boom, and I get in ahead of myself. Now, I don't wait for the price to come to me. I jump in there, and all kinds of bad shit tends to happen to you. Anyway, check out that other video. Don't make anticipatory Forex trades. I'll try to remember that and put that into the comments or the description of the video if you want to check that out. There is a condition where such a far out limit order would be valid, but that brings complexity into your trading plan, and you have to make some serious probabilistic judgments as to if you have a clean enough market to execute within in order to do that, right? So let's get into a little bit more detail on this, and we'll see. But I think first of all, I got to get a cup of coffee or something here because I'm running dry. All right, got my coffee. That's important. I don't know how I got started doing a video without having coffee. We're talking about a far out limit order, right? And why they're probably not a good thing to do. So let me put up a diagram, and I'll just talk over that diagram for pretty much the rest of the video. I drew this out. I was talking with somebody the other day, and I had drawn this out for them as we were discussing a process of staging in lots, and we talked about this particular issue that was involved. So look, in the black is the axis of the, and then the black is the price. The current price is set at that where that black dot is at the far right edge of the chart, and that's where the current price is. So you can see the initial order that I'm putting on. I have a buy entry order as a limit right above where current price is, because I want price to come to me. I don't want to just do an anticipatory trade and just grab that order where it is now, because it could easily turn around and go the other way. I mean, perhaps the chart doesn't correctly display a valid trade entry event. This is for entertainment purposes only, and just simply to show some structure so that you can sort of see what's going on with my discussion. All right, so you've got a buy entry order there at some level in green, and above that there's a sell, there's a profit target, and that's also a limit order. And you can see that that sell order is premised upon some structure toward the far left of the where the current price is. So I'm looking at this. Remember now, I don't have that blue continuation on there. All I'm seeing on the chart is the black dot where current price is. So what I'm seeing is an immediate profit target where I've put my sell, that first sell order at the profit, where it's marked profit target. But I'm looking at that chart and I see way off to the left is a lot of chop, a lot of order congestion. And I'm saying, well, gee, price could probably get up there as well, but I've got a pretty solid sell point for my current order right there. But if price could get over that a little bit, then I should have another entry, which would be out the far out buy limit order, which is in green. It's that third written thing on the axis. And then my profit target would be that congestion area way further over to the left. This could be a daily chart, could be a 5-minute chart, doesn't make any difference what it is. But there's some structure out there that would indicate setting a sell, which would be a far out sell limit order. Now you notice that the conditions of calling it a far out buy limit order and a far out sell limit order is the fact that I've closed the initial trade. If I was simply entering a buy order at the initial point right above where current price is, and then the sell profit target was a stage out, and then there was another buy order followed by another sell order, then that would be simply a staging process where I would go in with some heat. I'd sell a little bit that gets some meat on the plate, and if it continues to go up, I would add to that with another order. That's a stage-in philosophy. But this is different. I'm looking at this and I'm saying, man, I've got structure way over there to the left. It's good enough to set a profit target out there, but I'm not going to hold the order beyond that, because there seems to be a lot of downward pressure on the price. You can see that if you draw some, like if you had a 55 period moving average on there, you probably wouldn't be buying into that, you'd probably be a seller. But this is just for example purposes, and why I'm saying, look, I'm just going to move up and I'm going to grab that 10 or 20 pips that's there, and then I'm going to get out, because price could very well bump into that structure and then retrace, right? So that's the motivation for me to say, well, if it doesn't retrace, then I'm going to want to go to that next entry point and ride that out to the next level. Those are far out limit orders. And tell me what's wrong with that. Tell me what's wrong with doing that. I'll tell you. Come back to me here. Get off the chart. I'll tell you what's wrong with it. The first buy-sell pair was a complete position, enter and close out. That determination was made on entry analysis. That entry analysis covered the life cycle of that position, and the position is closed. In order for me to do what I did in that example by setting the next far out buy limit order, is I would have to redo my entry analysis at that point. at that time. But I didn't. I'm doing it now. But that, between where I'm buying and where I'm selling, could be, it could be 20 minutes, it could be 2 weeks. It doesn't make any difference. The entry analysis was done for that position life cycle. And I feel good enough about it to close the entire position out. I should not be setting that far out buy limit order, because you know what could very well happen is that you could get a blow off that would take your sell profit target and go blowing way beyond that to that far out buy limit order, and you would probably be in there with some heat. And then the price at that point, because I don't know what's happened between my profit target sell and the far out buy limit order. I don't know what conditions have happened at that point. If I sold it at that point, then I could do the analysis as to whether I wanted to set the far out buy limit order or not, based on what price action was doing when it took me out of the profit. But I didn't do that. And so price is going to see my order up there, and there's a lot of other fools that'll be up there with orders sitting there with buys. And so the big institutions will say, this is a wonderful opportunity to go in and grab all those orders and then sell the shit out of this thing. And so where I've got the far out buy limit order could very well be a swing point going in the opposite direction, and price could very well pin bar all the way down, well, not pin bar, but it could very well go all the way down in a 200 pip panic 15-minute drop and go not only below where I initially bought, but all the way down to that lower structure. Let me put the chart back up because I'm looking at it on a whiteboard right now. So you can see what I'm talking about. At that second limit order, that far out limit order, price could effectively spurt from somewhere between my initial buy and sell. It should just jam up and hit not only my sell, but also trigger the far out buy limit order. And then immediately turn around without going to the sell point and drop like a stone. Now I've got a far out buy limit order at, let's say that's at 1040. And it could go all the way down to 1010. And you're going to drop 30 pips before you can get out. All right, come on back to me. Here we are. That's the danger of setting these far out limit orders, because you don't know what the price action conditions are going to be when that happens. All you can, from a probabilistic standpoint, say is it'll get to my first profit target. When it gets there, that's the time that I could say I'm gonna make that decision whether to put that order in or not. Now, what you can do when you're setting up the conditions for your first buy and sell position is you can say, gee, if such and such happens, it could go to here as a buy, and then I would have a profit target up to where I've shown it. I could draw a green line where I would want to buy, and I could draw a red line where I'd want to buy, but I shouldn't be placing actual limit orders at those places. I might have my computer trading platform sound an alert if price was to continue beyond the sell profit target at a certain point. So my attention would be drawn to it. I could look at price action at that time, and then at that point I would do the entry analysis for a brand new scenario and trade. Those are two totally separate entry analysis areas. They're not one. You can't fucking combine them. You can say in a perfect world there's a probability that price is going to go on and continue and run into that higher. I keep pointing over to my chart. I'm sorry. Put the chart back up. You can't say with any certitude beyond where my current profit target is. I mean, I wouldn't take the trade if I didn't think that my probability of hitting the profit target was extremely high. But the probability of it hitting the next buy order and then going all the way to the far out sell order, there's a probability, of course, that that's possible, but it isn't good enough to create a limit order right now. If you thought that the probability was exceptionally high for you to go all the way to the far out sell limit order proposed position, then you would simply eliminate the middle two sell and buys so that your buy entry order would be paired with a sell profit target order where the far out sell limit order position is, right? In other words, that would be your position. But if you don't feel that it has come on back to me. If you don't feel that that the price has the special juju magic juice to go all the way to that limit order, but it does have a high probability to get to where you think it's going to get to, and that's not just 5 pips, it's got to be like 10, 20 pips, something like that. We'll set that profit target there and watch that very closely. And if it starts to chatter before it gets to that sell profit target, in other words, it's starting to hint that there could be a reversal, well, then you just sell out. You don't get your full profit target, but you get a piece of it. And then watch what happens. If price goes back to where your profit target was and looks like it's going to continue to go out, then you could look at that as a new entry order where you're proposing that the far out buy limit order line that you drew and its corresponding far out sell limit order exist, and see whether that constitutes conditions for entry analysis from a probabilistic standpoint that is going to be strong enough, okay? So the issue here is you need to understand the difference between an anticipatory trade as opposed to setting up a trade where you're staging in a series of orders and setting buy and sells between where you are and a real profit target, as opposed to setting up the conditions for a complete life cycle of a trade, and at the same time then setting up the conditions for another position complete life cycle, because you don't have the information to do that, okay? So that final scenario that I just mentioned, that is the conditions where you'd say that you had a far out buy sell limit order position. Now don't use the terms far out. They're not industry terms. I just made them up in order to discuss this, because it separates a proposed buy-sell currency pair entry analysis situation from what would be a bad situation of setting far out limit orders, okay? So if you email me 6 months from now and say, hey, what other conditions would you have concerning far out limit orders setting, I wouldn't know. I wouldn't probably remember what I'm talking about, because what I'm talking about now is principles. It's not a static thing. Well, people call me all the time. I need a rule to do this. I need a rule to do that. There's no fucking rule. There's principles. If you're not willing to learn principles, you're fucked. I'm sorry. I mean, you're screwed. There's just no better way to put it. You got to get away from these. There's times where you have rules, but those rules have to be based on principles. That's why my first course is principle-based trading, and the second course expands on that with a much more in-depth process of how. The first course is all phases as total principles, not any rules or anything, but just total principles. In fact, there's some very, very, very hard, fast rules that are based on the general principles of trading. So when I'm talking to you on these videos, that's the type of thing that I'm talking about doing. But from a course standpoint, if I'm going to be presenting this stuff, or if you were taking consulting from me, that would be, you'd have to discuss all the principles up front and set your foundational rules on that. And then you'd have to have a course, which I do, which breaks out the how of implementing those rules. Because you've got the what. What do you do? What's a PIP? How do you size your bank? What are all those? What's a Bollinger Band if you're using Bollinger Bands? There's the what of trading. There's the how. How do you implement a moving average crossover system? How do you implement ATR and candles? So that's the how part of it. And there's rules surrounding how you do things. There's rules about what you do to set your what I call the life cycle of a currency pair problem domain up. Then you have the how of how do you implement those rules against your framework of trading. And then the final thing of that is what I call process-oriented trading, which is the when part. What do you do, how do you do it, and when do you do it? Those are the three scenarios that are the framework of the life cycle of a FOREX position, right? You have entry analysis, you have position management. I'm sorry, I have a brain crack here. You have entry analysis, position management, and you've got exit methodology. Those are the three problem domains within the framework of the life cycle of a currency pair that you need to figure out rules for and how to solve them. But they all have to be based on principles. And so this is a principle of that educational process that I'm trying to help folks with. But unless you really get down and understand the root core of these principles and how they're constructed, you probably are going to have a hard time working up your own set of rules that are consistent with those principles. You really have to sit back and look at it. You can't just jump into this shit and start trading and wonderful things happen. It takes a long time to do it that way. I mean, that's the way that if you're going to do it on your own, that's the way you're going to have to do it. And the trouble with watching videos from different people is everybody sounds like they've got a great idea. I don't do anything like anybody else on these videos does, because I don't teach stuff. I teach principles. That's what I teach. You watch some guy live and he's drawing his support lines. He goes, okay, if the price gets to here, that's where we're going to buy it. If it bounces off that, and then we're going to do this. So that's the stuff. That's how to do it. All this other kind of stuff, but it's not principle based. The person may have principles behind it, but unless they're addressing your particular experience level and how you're viewing things, it's very difficult for you to take all these different approaches to how they're doing stuff and seeing how you would be able to implement it, and more importantly, when it would be appropriate for you to do it, because your personality is different from a lot of other people. If you're not a very patient person and you're watching somebody doing a video that's all his system is based on patience and waiting and holding, you're going to be in conflict with that. If you don't understand the principles that they're trying to talk about, if you're just looking at the stuff, you're going to have a hard time. And so not many people appreciate my videos for that purpose, because I'm not giving you the secret sauce. It's not that I don't want to give you the secret sauce. There ain't any secret sauce to give you other than the principles. And then we'd have to work together to figure out how to put this stuff together. That's how you make this stuff work. Or you've got to have a good enough background where you can listen to the stuff that I'm talking about and figure out how to implement that correctly, not only how, but also when. Anyway, the purpose of this video was to discuss the dangers of doing far out limit orders. So probably not a good thing to do it that way, but rather to break your trades up either into this is a completed trade and this is a proposed completed trade that I'll, in my entry analysis, I'll reevaluate when it gets to that point, or rethink where you're setting your profit target and then doing some staging out on the way up to take some meat off the table and then staging in to load in. I'm not a big fan of teaching somebody with less than a couple of years of trading or a couple of hundred trades at least anything to do with staging, because I think it just complicates the principles. I mean, if you don't understand the principle, if you can't take a one mini lot, $1,000 account, and make 30 or 40% of that on that a year, or 20%, and be at least consistent with your trading, so you're not having these huge spikes in your P&L, you got no business even thinking about doing staging trades in or out. Well, that's just complexity. If you don't understand the principles of trading, you can't make that work over a consistent enough basis where you've got a good enough win-to-loss ratio with a high enough average win rate per trade with an expected per trade value. How are you gonna do all this other type of exotic stuff? Anyway, that's my song for the day. Don't do far out limit orders. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.